The chaotic, multiple-offer gold rush of the Florida real estate market over the past few years has officially ended. Today, buyers are no longer bidding blind in this market. The market itself has completely flattened out, and the median single-family home price is holding steady at roughly $415,000. This chart shows how the market actually rebalanced. While the median price line remains completely flat, the volume of available homes has skyrocketed, doubling from pandemic lows up to a 4.6-month supply. That 4.6-month supply gives buyers something they haven't had in years: time to breathe, run the numbers, and actually negotiate. On top of that, mortgage rates have settled near 6%, removing the extreme rate shock that paralyzed the market in previous years. But beware, this creates a very dangerous illusion. People see flat prices and high inventory, and they mistakenly assume they are walking into a cheap buyer's market. Jumping in based purely on that $415,000 sticker price is a trap. Negotiating power on the sticker price has returned, but those gains disappear once you factor in the extreme hidden carrying costs. We call this the Florida sun tax. It is the massive, unavoidable rise in mandatory homeowners insurance and property taxes. Years of catastrophic storm losses have forced major carriers out of the state entirely, leaving the remaining insurers to hike rates just to survive. The math is brutal. A $6,000 annual insurance bill essentially adds $500 a month directly to your mortgage payment. That effectively destroys your true purchasing power. Navigating the market today is no longer about finding a cheap house. It requires you to meticulously underwrite a property's insurability before you even think about making an offer. For out-of-state relocators, the primary motivation for moving is often escaping high-tax environments like New York or California. Florida has zero state income tax. For many migrating households, that translates to $5,000 to $15,000 in cash savings every single year. But those tax savings are instantly vaporized if you buy a home in a coastal flood zone, where insurance premiums absorb the difference. To protect that money, you have to focus on the single most critical property feature in the state: the age of the roof. Insurers now enforce a strict 15-year rule. If a roof is older than that, carriers will either hit you with massive premium multipliers or deny you coverage outright. Attempting to buy a discounted home with an older roof forces you to burn $15,000 to $25,000 in cash immediately after closing, just to maintain your insurance. This checklist shows the exact criterion to stay safe: target properties under $425,000, secure a roof under 15 years old, and avoid flood zones. With high transaction costs, you must hold the home for 7 to 10 years to break even, and do not use the outdated tactic of waiving inspections to win a bid. Florida's unique climate hides termites, moisture rot, and foundation settling that you cannot afford to inherit.
The winning strategy for buyers requires sacrificing coastal proximity and luxury upgrades for inland, structurally solid, move-in-ready homes. Current homeowners who are sitting on massive equity are finding it incredibly difficult to adapt to this new, balanced environment. This table breaks down pricing strategies and their true outcomes. If you base your list price on what your neighbor got 2 years ago and overprice by 10%, your home will sit for 90-plus days and ultimately sell for less. Buyers are cash-strapped by 6% interest rates. They refuse to buy homes with deferred maintenance, which guarantees aggressive lowball offers on any property that feels outdated. Sellers must swallow their pride and price slightly below current comparables on day one. Letting a listing go stale is the most expensive mistake you can make right now. For investors, 6% interest rates and sky-high insurance premiums have completely broken the old pro formas. If you put 20% down on a standard $350,000 rental property today, you will face negative monthly cash flow. Achieving positive cash flow now requires tying up significantly more capital, often demanding up to 30% down. The alternative strategy is to abandon monthly cash flow entirely and commit to a 5 to 10-year appreciation game. The highest risk investment trap in the state today is buying older coastal condominiums to run as short-term rentals. Following the tragedy in Surfside, the state implemented strict mandatory structural safety regulations for older buildings. These regulations force condo associations to hit owners with special assessments ranging from $30,000 to $100,000 to cover immediate structural repairs.
When combined with 40% annual insurance hikes, these assessments frequently push a short-term rental's net income below the break-even point. Capital is now shifting toward the $350,000 to $400,000 price range, an area of the market currently seeing high inventory but much lower buyer competition. The appeal is now in inland single-family rentals or new built-to-rent suburban communities along the I-4 corridor, where maintenance risks are practically zero. This quadrant chart maps out the investment landscape. Pre-2000 coastal condos are stuck in the high-risk, negative-flow zone, while inland single-family properties offer a stable, low-risk, moderate-flow profile. You can no longer rely on quick Airbnb flips. Florida real estate investment is strictly an institution-style, long-term fundamentals game. In 2026, Florida real estate functions as a stable, long-term utility rather than a speculative asset. This flowchart outlines exactly who should move. Buy if you have a 7-year horizon, target inland suburbs, and get a new roof. Sell if your home is move-in ready and priced accurately. Avoid buying if stretching your debt limits or targeting older coastal condos. The smartest real estate decisions aren't made by trying to time the market's bottom. They are made by meticulously auditing the hidden carrying costs before you sign the contract.